Hello viewers, in this video I'll be going over natural gas, ETF ticker symbol UNG. Today we are up 3.7% and we have about 2 hours left in trading. On the 1 hour chart we are overbought on the 1 hour RSI, and on the 4 hour chart we are also overbought on the 1 hour or 4 hour RSI. And if we expand out to the daily chart, we are also overbought on the daily RSI, and we managed to break a nice resistance. So let me point out where that resistance line that we broke out to. So as we noticed that the 50-day moving average acted as a ceiling for us, but we managed to very nicely break out of it. And we also at the same time managed to break into positive MACD. So where could we head next is there's a good possibility we may even touch the 200-day moving average in the next coming days. Then again, it's a commodity, so commodity prices can swing both ways dramatically. So we can mark the 200-day moving average as our next possible resistance at the price of $23.80. And as for support, if we do lose steam, I do see possible support at the 9-day moving average, and that also coincides with the 150-day moving average, or actually this is the 100-day moving average, this orange line. So if we do lose steam, and we see that as possible support. And so if we were to move on higher, let's see if we get the percent movement. So if we were to move on higher, that price movement is roughly 6.3%. And if we do lose steam and move down lower, that price movement is roughly around 8.5% down lower. So let's head to the forecast model. On here, I'll go day by day where natural gas will head to in the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecast models we should focus on? Ideally, the model that is the best match to the current trend. We have the current trend right here, and this trend right here is the best match to the current trend, and this trend dates back to, I would say, December 7th, 2012 to March 7th, 2013. So let me point out why these two charts are similar. So what we have in the beginning of the trend, we were touching the bottom Bollinger Band. So let's just mark all the bottom Bollinger Bands first. We have one at the beginning, one right here. So let's mark all placements where it touched the upper Bollinger Band. One right there, and right towards the end right here as well. And let's mark where it reverted back to the mean, or where it touched the middle Bollinger Band. So we saw this instance right there. So let's see if the trend in question is similar to the current trend. So what we have in the beginning, we touched the bottom Bollinger Band right here. And let's mark all the bottom Bollinger Bands. So we have one instance and the second instance here. And let's mark where it touched the upper Bollinger Band, right there. And then finally the last one was right towards the end. And next, let's mark where it reverted back to the mean, or where it touched the middle Bollinger Band. So we see those instances. So we have about 1, 2, 3, 4, 5 points. We also see 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So again, the trend that we just examined was December 7th, 2012 to March 7th, 2013. And back then, natural gas was up around 7.5%. So we may see natural gas continue to move on higher, possibly hitting the 200-day moving average. So if you want this software, you can sign up in the link below, and you get it once it releases. So that is all. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.